Hello, I'm Kyle Caldwell, and this is On the Money, a weekly look at how to get the best out of your savings and investments. Since the start of 2023, global stock market returns have been heavily influenced by a small number of US technology companies, the so-called Magnificent Seven. However, there are plenty of other opportunities for investors to consider, both within the technology sector and outside of it. Joining me today on the podcast to discuss the case for Europe and to explain how investing in Europe can give investors exposure to technology trends is Daniel Avigad, a fund manager at Lansdowne Partners. So Daniel, we all know that Europe does not have the Magnificent Seven stocks. So what do European markets offer for investors that are looking for technology exposure?
I think it's interesting. Europe has a number of unique technology dynamics that are going to increase in relevance in the next decades relative to the past. So obviously, all investors know that Silicon Valley is the sort of global hub for software engineering, and that's what we call technology. But there's other faculties of engineering that are going to become really interesting and valuable to solve some of the world's large problems that are shared by many parts of the globe. And those will reside in understanding other faculties of engineering, so mechanical engineering, electrical engineering. And Europe houses domain expertise in both of those additional categories of engineering, which I think is going to make growth investing have additional avenues geographically to tap into in the future, not just the US, but also Europe.
And are those the main subsectors within technology sector in Europe, or are there also others?
Yeah, I think the technology sector within Europe's sort of quite a broad house. So it's obviously got the semiconductors, and within some semiconductors, there's two subsets. There's the lithography equipment manufacturing, so the capital equipment, and then there's the traditional semis. It's also got a second category, so there's four. The second would be telco, hardware and software. The third would be sort of IT services, and the fourth would be sort of platform companies that have just geographically transplanted a solution that works in other geographies, and it's being tried in Europe as well. So it's sort of four quite different dynamics there, some of which we find attractive, some of which we're less interested in.
And the fund that you manage has around 9% in the technology sector. Which of those four subsectors that you just talked about are you most interested in? Which ones do you have exposure to?
Yeah. Well, I think it's one of the most interesting at the moment is the IT services subsector, where obviously with a cyclical slowdown affecting business spend in the last few years, we think the earnings are quite low relative to long run trend, and multiples are too. So we're getting the optionality associated with the structural dynamic of increasing IT budgets across the world, supplemented by this investment wave into AI against companies whose multiples are cyclically downtrodden. So that would be probably the area I'm most excited about of the four. And then, of course, the sort of capital equipment lithography end of the semiconductor value chain, has such a long-term structural opportunity that when you can get into that cheap, and there's times when that's possible, it's worth considering if you're a sort of longer-term investor.
I wanted to next ask about the valuations. I mean, how cheap are some of the companies in the technology area in Europe?
Well, I think one of the advantages of being a very good business in Europe is that you're sort of not often valued as if you're a very good business in the US. And that doesn't reflect always the quality of the sort of fundamentals of the company. So there are times when it's particularly interesting. I think I wouldn't draw that more broadly across the European space, but I do think with a sort of rifle shooting approach, one can find pockets of real value at this moment in time. So a selective approach, I think, can be at this moment a very interesting way of doing things.
Now, the Lansdowne European Special Situations Fund, as the name suggests, invests in special situations. So could you talk us through how you define that term?
Yeah, I guess what we think of when we talk about it like that is that in our minds, all companies are producers of commodities. And analysis of commodities starts with the balance between supply and demand. And we think there's two special situations, with that sort of capital cycle lens in mind. One is where early in the company's life cycle, demand for the product is well in excess of supply. And if that's not discounted, it could be a really interesting time to invest because supernormal returns are possible. And the second is much later in that capital cycle, where after a period in which the growth has abated and excess capacity has really created poor returns for a while, you get the supply side rebalancing. So enough pain is felt that the supply in the industry consolidates or rationalizes, players go bankrupt. If you're invested in the survivor, when their returns are improving, but prices don't reflect that, it can also be very interesting. So one where at the beginning demand exceeds supply, and the other is when supply is falling relative to demand, and that's not well discounted. Those are the two special situations we're looking for.
And when you're looking for those special situations, are there any valuation measures that you set your store by more than others?
Yeah, I think one pitfall that perhaps early on I fell for, and hopefully have learned from, is just to find the thing on the lowest multiple and say that's the cheapest stock. What really matters, I feel, is the ability to grow and return capital at the same time, which typically comes down to what's the return on capital that a company can generate relative to the valuation that is discounted. And so that leads you to being able to invest both in low PE and high PE stocks, but taking into account the quality of the business and its terms of trade.
Now, while Europe does not have the Magnificent Seven, it does have its own investment acronym, the granolas. And according to some fund managers, this group of companies, which span pharmaceuticals, beauty, tech and luxury, are a viable alternative to America's Magnificent Seven group. What's your view on these 7 companies? Don't think you've got any of them in your top 10 holdings. To me, that indicates that you don't have any exposure to them at all.
Yeah, the best way, for me at least, to approach these is sort of to speak to the individual sectors that you just talked about. We in general find pharma quite challenging because in many ways, even if it's a good product, your patent expires on that within the next 5 to 10 years, which makes it something that has to repeat every 5 to 10 years. You have to come up with a great new idea that no one else has. So it's not as easy a business as many other industries face where, for example, you could sell Kit Kats into perpetuity. Luxury, we find challenging as well because the hardest thing to predict, at least in my opinion, is how trends evolve in terms of demand. So sort of mass market psychology and fashion trends, I think, are very hard to predict, but you have to believe in them if you're to invest there. You know, you talked about consumer staples, I think, and there we happen to be, in my mind, at a moment where the consumer is changing their habits with respect to what they want to consume. So we're moving from cheap and abundant calories to personalization. And that is a very different business model to that which a large number of consumer staples companies have built their factory footprint and mass marketing footprint over the last decades. So I would say that actually when one drills into the changes in the relationship between the companies that you named and the customer, or their ability to, over long periods of time, generate very attractive returns, there are some vulnerabilities that need to be considered. And our approach, rather, is to find through, as I said, rifle shooting, niches within the European environment. So not sectors, but specific companies where through due diligence, one can find really attractive dynamics that are going to persist for much longer periods into the future, we think.
And are there any of those niches that you can highlight?
Well, yes. I mean, my view would be, as a broad point, that in the absence of sort of very, very high real economic growth, which I don't think most mature economies are going to have because working age populations are in decline demographically, I think the value of productivity enablers is going to increase. And there are 2 forms of productivity that I would like to invest behind. The first are those who are innovators, so they have solutions that improve the productivity of their customer base. And the second are those who are operating in oversupplied industries where we can reallocate inefficient or unproductive resources to other areas of the economy through that supply side consolidation I just described. So for me, it's again niches. One I could give you an example of is outsourcing companies. So companies that allow their customers to focus on their core business model while taking over a non-core function and doing it in a much more efficient fashion than others could. Contract catering would be an example, construction equipment rental, pest control services, those sorts of things. But as again, there's the unifying theory is what's helping the customer. It's not one sector, it's many different niches.
In terms of reasons to be optimistic on Europe, I often see asset allocators make the point that Europe is a lot cheaper than America. What do you make of those sort of comparisons? Are they helpful? And how cheap is Europe?
Yeah, I think that's a great question. Not often enough asked. My view would be that it is helpful to be able to contextualize valuations in a historical context, but also cognizant of just how much is different every time you draw those comparisons. I think the really interesting parts of Europe are not the large sort of incumbent sectors that make up most of the market cap. And although they're on low multiples, they are for a reason. And in reality, what is fascinating about Europe is those companies that are trying to solve the region's fundamental issue, which is basically a deficit of natural resources relative to the size of the economy. And faced with that issue, solutions are being invested in earlier in this region than anywhere else in terms of sustainability or circularity. Those solutions, I think, are going to become relevant to the globe, not immediately, but over the long run. And a lot of the investment has been sunk by companies in Europe in ways that haven't happened in other parts of the world for their competitors, leaving them with a structural advantage as the value of those solutions becomes more viable or visible or important to a wider set of potential customers.
And I also want to ask, we'll end on where you're finding the most compelling valuation opportunities at the moment. You've mentioned outsourcing companies is one area. Are there any others that you could highlight?
Yeah, and I apologise, Carl, because I can't talk specifically to names in the fund. I'm sorry for that. But maybe more broadly, I could talk about some other areas that we find interesting. I think one of the areas I mentioned was sort of outsourcing. Another, and this sounds a little bit negative, is avoiding. So there's alpha from commission. There's also alpha from omission. Avoiding pitfalls, I think, is going to increasingly differentiate relative fund performance between funds. And I think what we've just seen in the last few weeks even is how expropriatory intervention from other stakeholders can be in terms of how investors receive their profits. So, for example, we've just had an 8 percentage point increase in the corporate tax rate in France. I think that's just one example of a long series of increasingly activist interventions by regulators and governments, given that sovereign balance sheets are under stress and deficits are already quite large. So one source of alpha in the future, in addition to just trying to pick the right stocks, is trying to avoid the big problems that I think potentially could emerge as we go through a process of trying to stabilize sovereign balance sheets that today are a bit out of equilibrium.
And when you are stock picking, how much importance, indeed, if any, do you place on the country where it's listed?
Yeah, I mean, it's, as you imply, it's increasingly relevant again, isn't it? I mean, it's not just the return on capital, but it's the return of capital. And it's very important when we go about thinking about companies to really understand, is there a structural alignment in the incentives of all stakeholders with us as shareholders? And that means that you have to be able to get your capital back in the long run and only investing in those companies operating in jurisdictions in which there's alignment, as well as operating business models that are not extracting profits out of the expense of other stakeholders. We need there to be an equilibrium. So it's becoming increasingly important and certainly something we consider.
And are the vast majority of the companies that you own global by nature?
Yeah, that's right. Europe's an open economy to start with, of course. So, I would say certainly less than 50% of the revenues of the companies we own would be actually originating in Europe. That's right.
And thanks to Daniel, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. If you get a chance, leave us a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website at ii.co.uk. And I'll see you next week.